If the Fed raises interest rates, the Fed lowers interest rates, it doesn't matter. We will still have an AI boom. If the Fed lowers interest rates, if the Fed raises interest rates, it doesn't matter. Politicians are still saying we need to do homeshoring of manufacturing capacity. And finally, also the one big beautiful bill, same story. If the Fed raises rates, it doesn't matter. It has already been written in the law. The money is already being paid out. So in that sense, when rates have gone up, the economy has not been slowing down.
Hello and welcome to another episode of the Odd Lots podcast. I'm Tracy Alloway.
And I'm Joe Wasenthal.
So, Joe, we had that live show in New York.
Yeah.
And we recorded multiple episodes. We thought just to challenge ourselves, we would do something a little bit different, which was a bold move for an audio-focused podcast. But we decided we would try to have a visual segment, right?
That's right. And it was also... It was a nice move because we got a break.
Yeah.
Like this was,
we cut ourselves out of the show.
We did a live show, and for a period, we just cut ourselves out. We gave ourselves a break. But, you know, it's good. An audience there. You want to mix up, give people a little variety so that this show is not just all like talking heads talking to each other.
That's right. And I think the presentation, I mean, we had the perfect guest, truly. Yeah. We had literally someone who's known as the king of charts talking essentially about how AI is eating the entire U.S. economy as well as U.S. financial markets.
No, and it was great. So basically, you know, what you're going to see is like his live presentation of charts. He was really good. You could tell he's done this before, but also a very like bold thesis, which is like, okay, like what do we think of as the new diversified portfolio? We might have at one point thought that the diversified portfolio was essentially the classic 60% stocks, 40% bonds. You sort of mix it up, you get a little diversification. And his basic thesis is no, there's AI is infected every part of the market. And so that to construct a balanced portfolio, you really need to have essentially your AI component and your non-AI component.
Basically, everyone is exposed to one factor now, which is AI. So our perfect guest was, of course, Torsten Slok. He is a partner and chief economist over at Apollo. Enjoy the charts.
So the idea with this segment was to give the host a little break and try to look at exactly the consequences of the discussion we had, namely what's going on with the economy when you have so much demand for compute, when you have so much demand for data centers. And the first way to look at this is, of course, to look at what is the overall situation when it comes to the number of data centers in the US economy at the moment. This chart here shows you to the left that today there are roughly around 4,000 data centers in the US. And as you can see to the right, the number of data centers that are announced or under construction is about 3,000. So obviously, as the conversation also led to, is the conclusion that we have a huge need for compute. And that, of course, becomes very important when we begin to think about what are the consequences of AI and what are the consequences of the data center build out for the economy and therefore, of course, overall for GDP. And one way to look at this question is to look at what are the engines of growth in the US economy at the moment. And that's what you see in this chart here. And it's not only AI that's driving growth in the US at the moment. The most important thing is that growth is, of course, coming from the data center build-out and the associated energy spending. We are also beginning to see some early signs of productivity gains from AI, and we calculate that that source on its own is going to add about 1 percentage point to GDP growth in 2026. Remember, GDP normally grows at 2, and now roughly 1 percentage point is going to come from AI alone. But there's also another source of growth in the middle, namely industrial renaissance. There's a very strong political desire at the moment to bring back production of semiconductors. This was the CHIPS Act in 2022 under Biden. Very strong. The desire was to bring back production of capacity of chips. And of course, that has been ongoing now for several years. There's also a very strong support for bringing back production of prescription drugs. The pharmaceutical sector is also likely going to see a lift because of the industrial renaissance. Again, politicians saying we need to do homeshoring of a lot of capacity that used to be in India, in China, elsewhere, but now needs to be done in the US. And finally, obviously, we also have a lot of activity when it comes to defense. And that is also an engine of growth that is also rather unusual, but for obvious reasons, it's also seeing a lot of activity. So this is a second source of growth that is also a significant tailwind over 2026. And finally, we also have the one big beautiful bill, which is also, of course, a very important source of growth. Remember, the one big beautiful bill lowered taxes retroactively. So Trump lowered taxes starting January 1, 2025. The consequence of that is that households on average this year will get a tax refund of $4,000. Last year, the average refund was $3,000. So that's $1,000 more per household. And given we have more than 130 million households, that means that over the next 6 months, we will see, going into the midterm election, more than $100 billion in spending for consumers because of the one big beautiful bill lowering taxes for households. And if you add to that also the tailwind coming from 100% immediate expensing, there's also provisions for infrastructure and defense. You also get, according to the Congressional Budget Office, that the one big beautiful bill will also be boosting GDP roughly also by 1 percentage point. And why is this important? This is extremely important because all these things are not a function of what the Fed is doing. If the Fed raises interest rates, the Fed lowers interest rates, it doesn't matter. We will still have an AI boom. If the Fed lowers interest rates, if the Fed raises interest rates, it doesn't matter. Politicians are still saying we need to do homeshoring of manufacturing capacity. And finally, also the one big beautiful bill, same story. If the Fed raises rates, it doesn't matter. It has already been written in the law. The money is already being paid out. So in that sense, when rates have gone up, the economy has not been slowing down. And that's exactly why non-farm payrolls next Friday is likely to come in at a very strong pace, because you have seen ADP over the last several weeks be very strong with 30, 40,000 jobs being created every single month. So a very important difference between the US and the rest of the world is that the rest of the world, take Europe, does not have an AI boom. Europe does not have an industrial renaissance, and Europe definitely does not have the one big beautiful bill. So the consequence is we have some very unique tailwinds to the US economic outlook at the moment that are very, very important when we think about what's going on in financial markets, and therefore very important when we think about what is the outlook overall. And if you now take this to your Bloomberg screen and ask the question, okay, so we have some tailwinds. What does that mean for growth? What does that mean for inflation? How should I think about asset allocation and investing with the backdrop of some very unique forces driving growth at the moment? And this chart here is ECFC Go on your Bloomberg screen. The white numbers is the median of the 60 people from the consensus who submit their forecast. And look at the second line in the chart. It shows you GDP growth. GDP growth, honestly, in the next 6 quarters is actually quite boring. It's more like 2%. It's a little bit weaker, as you can see, for the next several quarters, probably because of the conflict in the Middle East. But generally speaking, GDP growth is not going to do much, not drama to the upside, no drama to the downside, just relatively steady at around 2%. But where is all the action? Have a look at the squared box in the middle. The consensus is telling you, and that's also the Fed's forecast, that's also our forecast for that matter, that consensus is saying inflation is going to go up. Inflation is going to rise from 2.7 to 3.7, and then 3.4, 3.3 to 9, and only come down to the Fed's 2% target as we get to the middle of 2027. Why is that important? That makes it very, very difficult for the Federal Reserve to cut interest rates. Remember, there are 12 voting members on the FOMC. One of them is Kevin Walsh. The other 11 members have literally just said, we're not cutting interest rates. In fact, 3 of them are beginning to say, maybe we should think about hiking rates. So the key backdrop for this strong growth outlook is that at the same time, we have that inflation is higher for longer, and as a result, interest rates will be higher for longer. So a very important conclusion when we think about the economic outlook, it's not only about the line that is called private investment, where you see very strong growth coming from data center spending, but it's also the backdrop that it's a very complex situation where you also have that inflation, and therefore rates, in this case, in the front end, are going to stay higher for longer, simply because inflation is higher for longer. So let's now turn to what this also means for financial markets, that AI has played such a big role for the economy. And let's now turn to see what does it then mean for asset allocation and for investing. If you think about your 60-40 asset allocation, normally you think about, well, 60% in equities, 40% in bonds. Let's look at what's going on the equity side first. And it's very clear, as we all know very well, the 10 biggest stocks in the S&P 500 now make up 39% of the index. In other words, the S&P 500 is no longer a diverse set of stocks. It really is a very big bet on AI. And what's interesting is that that's actually now also more and more the case in fixed income. So think about the 40 side of your asset allocation. So 60% is equities, 40% in fixed income. What's going on in fixed income? Well, if you look at investment grade credit to the left, year-to-date issuance, you've seen that 49% of issuance is hyperscalers. In other words, it used to be the case that investment grade was mainly financials. But now hyperscalers are coming in because they need to get financing for the data centers. And that's why roughly half of issuance this year has been coming from AI or from the hyperscalers. Even for venture capital, it used to be the case that venture capital, that was invention of prescription drugs, pharma, biotech, but now 87% of venture capital is also AI. And finally, even for high yield, you also have that AI makes up a growing share. So the problem is now that if we begin to think about this from a 60-40 portfolio perspective, is that AI is now everywhere in equity and fixed income portfolios. And if there's one thing that we have learned in finance in the last 15 years, it is that you should make sure that you are invested according to certain factors. And suddenly we all wake up and we're all exposed to one factor and one factor alone, namely AI is everywhere in my equity portfolio, and now AI is actually also everywhere in my bond portfolio. And that's why, and I say this a little bit as a joke, but it really ends up being really true, that it used to be the case that 60-40 was, oh, I just buy some bonds, I buy some equity, and when something goes up, the other part goes down, and vice versa. But we almost gotten to a point, well, hold on, now there's AI everywhere in my equity portfolio, and now there's AI everywhere in my bond portfolio. So now it's almost become the case that instead of just being exposed to one factor, namely AI, maybe I need to think about this much more, that the new 60-40 is that, am I exposed to AI? Am I also making sure that I'm exposed to non-AI? And the last conclusion to combine those two things together is, of course, that this is beginning to put some upward pressure on yields also because of hyperscaler issuings being a substitute also for treasuries. And that means that the yield curve is not only under upward pressure because of inflation, the yield curve in the belly is also under upward pressure because of issuance of hyperscalers. And finally, in the long end, the yield curve is also under upward pressure because of issuance of treasuries. So the key conclusion is, from a macroeconomic perspective, is that the economy is doing just fine. And the bottom line is the tailwinds coming from the data center growth, also from the industrial renaissance, and at the same time also the one big beautiful bill. It tells you that growth for the rest of this year is at risk of accelerating. And that, of course, becomes very important when we already have an outlook that inflation is telling you that we have a profile where inflation, in particular if the Strait of Hormuz remains closed, that inflation could be even higher and the mountain even higher than the Bloomberg screenshot that you saw in terms of what expectations are for the next 18 months. So the bottom line, when you look at the outlook, is AI is literally everywhere in your portfolios, and AI is extremely important for the GDP outlook. So it becomes very critical to think about this in the form of, well, what happens if AI is more successful? And in the worst case, what happens if AI is less successful? Not only will GDP growth slow down, but our portfolios, not only in equities, but also in fixed income, will unfortunately also be at risk if AI does not deliver on the significant promises that we're seeing at the moment.
All right, that was Torsten Slok of Apollo's presentation. Lots of good charts in there. I'm Tracy Alloway. You can follow me at Tracy Alloway.
And I'm Joe Weisenthal. You can follow me at The Stalwart. Follow our producers, Carmen Rodriguez at Carmen Armin, Dashiell Bennett at Dashbot, Cale Brooks at Cale Brooks, and Kevin Lozano at Kevin Lloyd Lozano.
And for more Odd Lots content, you should check out our daily newsletter. You can find that at bloomberg.com/oddlots.
And you can chat about all of these topics 24/7 in our Discord, discord.gg/oddlots.
And if you enjoyed Torsten's presentation, then please leave us a comment or like the video, or better yet, subscribe.
Thanks for watching.